If you give me 25 to 30 minutes of your precious time today, I will show you step by step and in easy everyday English how to fill out Schedule C of Form 1040. At the end of this tutorial, you will know how to report a sole proprietorship's profit or loss on your tax return. I guarantee it. All right, folks, to make it easier for you to follow, we'll use fictitious data about a sole proprietor who makes money on the side by selling stuff on Amazon. This could be Shopify or Etsy, doesn't matter. And we'll go step by step, showing you the numbers and, when necessary, explain important theoretical tax concepts that the IRS cares about. Whenever necessary, and this is important, please pause the video to let the information sink in before resuming the video. To prepare your Schedule C, you need data about your business, and this can come from a variety of sources. It can come from your accountant, it can come from your company's financial statements, either in a spreadsheet or via the accounting software you use. Let's get started. I want you to see right now Part 1, Schedule C on the screen. So you put your name, your social, you put your the principal, business, or profession. In our case, we put a hypothetical category. It's online tax education. Okay. B, you have to put your professional activity code or your principal business code. And this you can see on the screen. We have actually copied. So we have screenshot number 1, screenshot number 2, screenshot number 3, screenshot number 4. So please look for the code that corresponds to your business. If you have any question, please email us and we'll be very happy to help you out. C, you have to put your business name. If your business doesn't have any name, leave this section blank. It's not a problem. Same thing for D. EIN, your employer identification number. Do you have one? Yes. If no, no problem. Let's move on. E, you have to put your address, your zip, your city, whatever. That's kind of easy. Section F, the accounting method. So you have 3 options here. You have cash, accrual, and other. One thing that's very important to understand is that the difference between cash and accrual accounting lies in the timing of when sales and purchases are recorded in your accounts. Now, I'm not here to give you a master course on advanced accounting, so I'm intentionally oversimplifying the dichotomy, if you will, between cash accounting and accrual accounting. One thing I want to say here is that most businesses use either the cash or accrual method of accounting. But some specialized industries use accounting methods specific to their trade. Let me give you an example. A construction contractor may use the cash or accrual method of accounting, but also use the percentage of completion. So if you are a contractor and you want to use the percentage of completion, then you put you actually check the number 3 and you specify it. Okay. And in accounting, we're now section G. Did you materially participate in the operation? Folks, in accounting or taxation, materially means significantly. It means substantially. All right. So when you hear the term materiality, it means significance. It means substantially. Okay. So if you run your business, you are working on your business 24/7 or 8 hours a day, you are having material participation. As a matter of fact, our good friends at Investopedia, you can see on the screen, have done a great analysis in terms of the test of materiality here that the IRS conducts. You can see on the screen. If you want to read more about it, go ahead and we will actually have the link at the bottom. Okay. H, you want to mention if this is a new business. And J, you want to, if you made payments to independent contractors in connection with your business, you want to mention that here. As a matter of fact, if you're interested in this topic, we have a video, IRS Form 1099, line by line instructions. Go check it out. I want to talk to you now about Part 1 income, folks. Are you with me? Are you following? All right. So Part 1, we actually put that we made 80,000 in sales. That's 1, Number two, you have returns and allowances. So returns and allowances happens, for instance, some business accounts for returns of merchandise separately so that they can track information about sales, right? Let's say you agree with the customer that you will be sending them a product, they will review it or whatever it is, and if they're not satisfied, they can return the product to you. This could be here. So in our case, we made $80,000 worth of sales. We got returns of $3,000, and so when you subtract line 2 from line 1, you have $77,000. Cost of goods sold, $28,000. Those numbers are all made up, but I will explain to you where they came from later on. But yeah, so the gross profit, you actually subtract your COGS, your cost of goods sold, from your gross profit, from your sales rather, 77,000, that's 49,000. Other income, we put in there 1,000. So your gross income is a nice 50 grand for the year. Do you follow me? All right. One thing I want to see here is that when we talk about line 7, line 7 is important because your gross income, because what's going to happen is that the IRS will actually, track or reconcile, if you will, they will trace that money, that gross income data to your financial statements. And there is a financial statements called the statement of income, your P&L, your profit and loss. So this is really important. And one thing I also want to say quickly is that there are some items that are not reported in part 1. For example, loans for any purpose or from any source, appreciation in the value of any property you own, certain exchanges of like-kind property, consignments of your products given to others to sell. If you sell business assets such as equipment, buildings, or land, the income your business derives is reported on other schedules in your tax returns, not here. Okay, so this is very important to clarify that part. And another thing I want to see also is that when we talk about, if you have, let's say you have operated more than one business throughout the year, if you own or operate more than one business, you must complete a separate Schedule C for each business. Let me repeat that. You need to complete a separate Schedule C for each business. So be sure that the income reported on each Schedule C pertains to that particular trade or business. The IRS is going to check it. And the last thing you want is to have your ass being audited by the IRS because they think that you have misled them or you have actually hidden income. You don't want that. All right. Let's talk about part 2 here, folks. Are you with me? Are you still following here? Look on the screen right now. Okay. Part 2, we have what? We have expenses, right? Expenses. So we have advertising. When we speak about advertising, we have broadcast and print advertising, signage. Okay, if you're interested in Section 179 expense deduction, we actually have covered that on other shows. Okay, because one thing I want to say is that the cost of signs that are more permanent in nature and that will benefit your business for more than 1 year, you can't deduct those here. All right, you capitalize them. In accounting, when you talk about capitalization, it means that you are actually taking an amount that should be expensed. You are making it as an asset, and what you do is you actually write off the amount over several years. So Section 179 deduction, we covered this on another show. Please go check it out. So when we speak about advertising, you have online advertising, you have newsletters, marketing materials, and the whole 9 yards. You have public relations, promotions, trade shows. You get it. Remember though, that letterhead, envelopes, business cards, those are not considered marketing materials. No, Jose, no. Those are expenses that should be office expense. Line 18, I'll come to that later on. Line 9, we have car and truck expenses. Okay, so here, if you use a car or truck in business, you can deduct the operating and maintenance cost on line 9. But please be careful. Be careful. The IRS will audit this line like crazy. They do that. And because they want to pay attention to not only the verifiability of the amounts, but they also want to make sure that you are actually not deducting costs that you should be amortizing. Okay, if you want to learn more about that, please check out our video on the Form 4562, asset depreciation and amortization. You also want to pay attention to the methods of deducting expenses. Do you want actual expenses or the standard mileage rate? Line 10, you also have here you have commissions and fees. And here you are basically putting everything that relates to the business, of course. And I'm talking about fees that you pay to non-employees to produce revenue for your business. Okay, this can include commissions you pay to independent sales representatives who sell your products or service. And it can also include commissions you pay to someone who prospects for your business, or a finder's fee you pay for a business that someone outside of your company develops for your business. If you have also more information, if you want more information about the fees that you actually pay to brokerages, you can go to our video on IRS Schedule C, line by line instructions how to report capital gains and losses. Those are totally different. So there are certain fees you cannot deduct on line 10. Fees you pay to independent contractors, fees you pay to attorneys, tax preparers, and other professionals, wages, bonuses, and commissions you pay to employees, fees for internet users, fees you pay to city for city or business licenses. All right, those you don't actually deduct them here. Line 11, you have contract labor. Line 12, depletion. This is for certain industries. Line 13, we have depreciation. Line 14, we have employee benefit programs. Are you following? Line 15, you have insurance. And please do not deduct health insurance on this line. Health insurance for yourself, automobile insurance, disability insurance, those will be put elsewhere. Line 16, we have interest. Okay, and if you're interested in the business use of your home, you can actually check out our video 8829. Line 17, we have legal services. Okay, legal services and other services. You have tax services, you have other professional services. Are you still with me, folks? So now we are talking about line 18. Line 18, you have office expense. So this is everything from supplies, utilities, furniture, rent. You actually, anything that relates to your business, you got to deduct it on Schedule C. So office expense, you have maintenance services, janitorial services, you have bottled water services, telephone answering services. Okay. And remember though, anything permanent in nature must be capitalized and recognized as an expense through depreciation, right? If it has a permanent nature, you have to write off the expense over several years. And there are some expenses not deductible on line 18. I want you to pay attention here. Are you with me? We have furniture and fixtures. We have home office expenses. We have office rent. We have leasing cost of office equipment. We have utilities for your office. Those are not deductible here. For example, utilities, you got to go to line 25. If you have done significant office renovations, they're not deducted here. Line 19, you talk about pension and profit sharing plans. Line 20, we have rent or lease. Line 21, repair and maintenance. Here I'm speaking about repairing a tear in your office carpet, repainting the inside of your office, fixing a leak in the roof, replacing a computer hard drive that crashed. Things that are not permanent in nature. Please do not take the deduction on line 21. For instance, if you replace the roof, if you added memory to a computer, because that's permanent in nature. If you replaced the entire motor of a copying machine, if you remodeled the inside of your office or building, those must be capitalized. Line 22, we have supplies. Okay, anything about cartridges, toner cartridges, pens, paper, notebooks, file folders, paper clips, you name it. Line 23, we have taxes and licenses, folks. So we have employment taxes, business licenses and permits, personal property tax, state and local sales tax, real estate taxes, other expenses that are not deductible. Line 23. So we have excise taxes, occupational taxes charged by locality, right? And one thing that's very important, and I want to specify, please do not deduct your self-employment tax or federal income taxes on line 23. Don't do that. And there are other expenses not deductible on line 23. So we have fuel taxes, we have estate and gift taxes, they're not deductible. Okay, income taxes, they're not deductible here. Part 2, we're still here with line 24, TME, travel, meals, and entertainment. Now, line 24 is one of the most frequently used by small business owners, right? So people pay attention to that, and so does the IRS. So please be careful here. And what you want to do here is that you want to understand that travel, meals, and entertainment, all those expenses are deductible if they relate 100% and they are ordinary to your business. The expense, for example, must be incurred while traveling or while conducting business. It must be an ordinary and necessary business expense. Let me repeat that. It must be ordinary and necessary. And the IRS will they will audit you for like real. So you want to be very careful here. Okay. The expense also must be reasonable. For example, if your business is generating $100,000 a year, you're not actually spending $5,000 or $10,000 on entertainment alone, right? It must be reasonable. So that's line 24. Line 25, we have utilities. Line 26, we have wages. Okay. Remember that. So here you have to deduct anything that accounts for wages. This includes salaries, commissions, bonuses, and other compensation. However, if you're a manufacturer, not all of your employees' wages will be deducted on line 26 because the wages you pay production workers, supervisors, and indirect factory workers are deducted on line 37 under cost of goods sold in part 3. And this is because I don't have time today to go into an advanced course on management accounting or cost accounting, but those costs are part of the products. They're part of the product. They are direct cost and indirect cost. So there are direct labor and indirect labor. Okay. One thing I also want to say here is that for tax purposes, reimbursed employee expenses can be treated in two different ways, depending on whether the reimbursement are made under an accountable plan, or a non-accountable plan. Again, we don't have time today to go through the details, but if somebody is interested, please email us and we'll be very happy to explain things to you. There are some expenses that are not deductible on line 26. For example, employee fringe benefits, pension, profit sharing, and retirement plans. Wages that you report on line 37 under cost of goods sold, and commissions and fees you pay to independent contractors. You want to report those on line 10, commissions and fees. And line 27, as you can see on the screen here, we have other expenses. And I'll explain how we got the number, the $1,000, later on. I'll be right back right after this. Don't go anywhere. Welcome back, folks. We are still in part 2, and you can see on the screen here we have total expenses, and our total expense amount to $21,500. And our tentative profit and loss, when you subtract $21,500 from $50,000, you have a $28,500. Okay, and here we have to talk about line 30. So expenses for business use of your home. And basically, to make things very simple, I mean, there are two ways you can actually calculate this. You can go with the simplified method, or you can go with the quote unquote, the complicated method. We chose simplified. And what it is that our home, our hypothetical home has a 2,500 square feet. And we chose to dedicate 1/5 of that area to the business. So 500 divided by 2,500, that's 20%. Okay. And how did I get the 4,300? Very simple. You take total expenses, 21,500, and you actually multiply that by 20%, and you get 4,300. That's how we got that. So your net profit or loss here, you have to subtract your line 28. Sorry, you have to subtract actually, line 28 from line 30. What am I saying here? No, you have to subtract line 30 from line 29. Okay, so your tentative profit and loss, which is 28,500, you do minus 4,300, and that's 24,200. Yes, got the math right. So it's very important to understand here is that there are certain things you have to be very careful. And we have explained that in a video that we did on Forum 8829, where we talked about expenses for business use of your home. And the IRS really audits that part also. So they want to make sure you have a regular and exclusive use of your home. This is very important. And so net profit or loss for your business this year, for your side gig, if you will, is $24,200, right? Congratulations. If you show a profit, as we did in our hypothetical example, that's fine. Your business is in the black. You have to pay. You have to take that amount and actually transfer that onto your 1040. That's good. If you show a loss, the amount you can deduct in the current year may be limited. Okay, so this is kind of because there are some limitations here, and it depends on your filing status. And one thing that the IRS pays attention to is what they call your investment risk. Okay, so basically they want to make sure that you have enough. You are actually standing to lose a lot of money based on the transaction here. So this is something you need to pay attention to. If you need more info about this, we have another video here. First of all, you want to look for Form 8582. And if you want to dig a little more, you can actually go to the website, to our channel. We have a video called IRS Schedule C, At Risk Rules and Passive Activity Rules. I want to talk to you now about part 3. If you remember, I was telling you earlier about the cost of goods sold. How did we get the number? So there are several ways to value closing inventory. Okay, you have the cost, you have the lower of cost of market, and you have other ways. Now we have no time today to actually go a little into much detail, but if you are interested, please email us, we'll answer you. But we just hypothetically, we have our beginning inventory value, 10,000, purchases that we made throughout the year, 50,000, the cost of labor, 5,000, and materials and supplies, 2,000. If you remember earlier, I was talking to you about costs that you cannot, labor costs that you cannot put on was it line 21 or line 22? I don't recall, but you have to put it as cost of goods sold. And this is what we're doing now. Okay, so you can't put it on line 11, contract labor. We have to put it as a cost of goods sold. And that's what we're doing now. And really what's going on here is that if you look on the screen here, all the costs throughout the year amounted to 67,000, and the inventory at year end is 39,000. So the cost of goods sold is basically beginning inventory minus ending inventory. So when you do 67 minus 39, you get 28. Did you get that? All right. So this is basically how we got the, and if you go back to part 1, remember part 1? I want you to look at part 1 right now. We have on the screen, part 1. Do you see line 4? Cost of goods sold, 28,000. That's how we got the 28,000. Okay. So now I want to show you one more thing before we move on to the next screenshot here. One thing that's very, very important to keep in mind is that there are something called other costs. Other costs, this is for manufacturers, and this can include containers, freighting, and indirect or direct overhead expenses that are necessary expenses for the manufacturing operation. Okay, and one thing I also want to say here is that some people like to count inventory manually. You can do that too, or you can rely on third-party software to do it for you. At the end of the day, you need to have a way to substantiate anything you put on your tax return to the IRS. If they ask you, you got to be able to substantiate that. And this is why either you count manually and you have data logs, or you have inventory logs to substantiate it, or you rely on third-party software. That's fine. Or if you outsource the whole operation, for instance, we are selling on Amazon, hypothetically, in our fictitious example, you sell on Amazon, so you outsource the whole shipping, the whole fulfillment to a third party, and you rely on their data for your cost of goods sold. That's fine too. I want to talk to you now about part 4. I want you to look on the screen. Are you still following it? Are you with me here? I want you to be with me. Again, you can always pause the video to let it sink in. But we are now in part 4. I want to talk to you about information on your vehicle. So here line 43, we placed our hypothetical vehicle in operation in 2018, and we have driven for business 10,000 miles, and commuting 2,500. Okay, and one thing I want to see here is that the line 44, the line A, business, this is business miles only. Line C, where it says other, in this space you want to enter all miles you drove other than business and commuting. You want to include all of the personal miles you drove. Okay, it's all about being straightforward here, folks. Very important. And line 45, we put yes, our vehicle was available for personal use on off duty. That's necessary. If you answer yes to the fact that you are actually claiming the home office deduction, then this question you must answer it yes also. And here, do you have another vehicle for personal use? We said yes. 47, do you have evidence to support your deduction? We said yes. And this goes back to what I said earlier, right? It's all about substantiating anything you put on your tax return. Be very careful here, because things like transportation expense, things like travel, meals and entertainment, things like home office deduction, the IRS will pay attention to it. Okay. And they're asking you on line 47B, is the evidence written? You gotta answer yes to this, folks. All right. The information must be written. I'm not telling you to actually write it down on a piece of paper, but it has to be. If it comes from a third party software tool, that's fine. Or it comes from your the shipping company that you outsourced your operations to, that's fine. But whatever it is, whether it is transportation or cost of goods sold, whatever it is, you got to have paperwork to back it up. This is very important. Line 48, folks, we are still having a conversation here. Line 48, we have other expenses. Do you see that? Other expenses. And this is something that you really have to pay attention to. And this is line 48, or part 5, rather. Part 5. Other expenses. There are a couple of things you can put in here. If you look on the screen right now, we put in uniforms, online seminars, cell phone with hidden identity, 6-month plan, one-off occurrence, whatever. And this is important because now, how do you reconcile this line 48, other expenses, the 1,000? I want you to go back with me. Please go back to, I want you to look on the screen right now. Do you see where it says part 2 expenses? On the screen right now, part 2 expenses, line 27A. That's the $1,000 that I want to talk to you now about. So let's go back to part 5, other expenses. This is how we got the $1,000. Are you following me? Okay. So in this category, you want to report everything else that you have not reported elsewhere. For example, business banking fees. I'm speaking about service charges, ATM use, overdrafts, online bill payments, copies of cleared checks, duplicate statements, debit card use, stop payments, all that kind of stuff. You can also include here business credit card fees. You have annual fees, late payment fees, fees for going over your line of credit, fees for additional or replacement cards, cash advance fees. But remember though, that those must come from credit cards that you use exclusively for your business. You also have business organization dues. If you have some dues, if you send dues to the chambers of commerce, trade association, professional organizations such as bar association and medical associations, if you have a civic or public service organizations, business leagues, boards of trades, real estate boards, all of that. And we also have merchant fees. Okay, if you have fees for publications and subscriptions to magazines, newsletters, and newspapers used in your business. One thing I want to see here is that when we speak about amortization of business startup cost, you can also put them here. obviously there is a reason why you can't put them in other categories, because as a startup, your business has not really fully developed yet. So you want to put all this amortization of a business startup cost here in this section, other expenses. To qualify as a startup cost that can be amortized and included in part 5 here, it must meet these 2 tests. It is a cost that you could deduct if you operated as an existing business. All right, so this is a cost that you could deduct if you ran an existing business, and it is also a cost that you could incur before the day you open your business. So those are 2 things that are important. And in terms of costs, we are speaking about costs related to selecting a business site, salaries for training employees, advertising for the opening of your business, professional and consultant fees paid in forming your business, cost of product and market research to determine the feasibility of starting a specific kind of business. All right, folks, this is it for today's conversation. To recap, here is our Schedule C fully completed. I want you to see on the screen right now. So we have part 1. We have the fundamental data. We have part 1. We have a part 2 expenses. So part 1 income, part 2 expenses. We still have expenses again. Then we have part 3, cost of goods sold. Part 4, we have information on your vehicle. And last but not the least, we have part 5, other expenses. Thank you so much for your attention, folks. I really appreciate it. I'll see you next time. Until then, remember, stay marvelous.